Yes, people, done with both the question? Yes, people, done with both the question? If you're done, then just say done. Hey, just tell me not done. Just say done. Done, sir, done. This week we will complete our syllabus, okay? So this is the last week. Chaliye. So now, again we are going to discuss. Sir, we have done. Just clap for us, na? Okay, we'll do clapping for you. Yes, sir. Done. Now, guys, we have discussed the how to determine the value of the asset. And guys, here we have discussed ultimately value of asset will be the actual cost of that asset or NRV as on valuation date. And NRV means the 1st April of the previous year. Now, suppose, sir, you have sold that asset before the valuation date. Then what will happen? Try to understand. Now just focus for the next 10 minutes. This topic will get over within that 10-15 minutes. Just try to understand. For an example, guys, suppose I have purchased this house. And this house I have purchased on 16 September 1992. Suppose on 16 September 1992, I have purchased this house in Nepal. So Nepal is also foreign. And I have purchased for 2 lakh rupees. So 2 lakh was the cost. What happened to my pencil here? So I purchased this house for the 2 lakh in 1992. Now guys, suppose I sold this house on 15 July 2022. In the last year I sold this house. And suppose I sold this house for the 15 lakh. Now in the current year, on the 10 December 2023, just AO get to know about that property. Then, sir, how to determine the value? Because cost of that asset was 2 lakh. I have sold that asset. On the valuation date, I don't have the asset because valuation date will be the 1st April 2023. So on the 1st April 2023, I'm not having any asset outside India. I'm not having any asset. So on the 1st April 2023, when I don't have the asset, then sir, how to determine the value? Because for the all asset, what was the value? Cost of acquisition or NRV as on valuation date. But before the valuation date, I have sold this asset. Then what will be the value? So here lawmaker says that before the valuation date, if you sold this asset, then your value will be whatever the cost of acquisition or your selling price, whichever is higher. Means on this also there will be a taxability, and guys, value will be your cost of acquisition or cost of asset or selling price, whichever is higher. So here cost of acquisition was 2 lakh and here selling price is a 15 lakh rupees. Then guys, here total will be here cost was the 2 lakh and 15 lakh, whichever is higher is a 15 lakh. So 15 lakh will be treated as the value of this asset. Here 15 lakh will be treated as the value of this asset. Now one more doubt. Suppose, sir, we have not sold. We have gifted to someone. Then we have gifted on this date. Suppose I have gifted this property to someone. So it is a 0 price. Then what will happen? How to determine the value? Or suppose I have sold for inadequate consideration. Then lawmaker says that whatever your cost or FMV as on date of transfer, whichever is higher. FMV as on date of transfer, whichever is higher. So whatever your cost of acquisition or FMV as on date of transfer. So this is the rule number 3.2. So what rule number 3.2 says that? Try to understand. This is very interesting. Asset transfer before the valuation date. Then whatever the cost of acquisition or sales value, whichever is higher. But guys, if asset transfer without consideration or inadequate consideration, then the cost of acquisition or FMV on the date of transfer, whichever is higher. Now guys, there is one interesting point that we will discuss, but I will take one example and from with the help of example, I will teach you this concept, but on this concept, there will be a question in the examination. So just pay attention. Here, rule number 33 says that where suppose new asset is acquired out of consideration received on account of transfer of old asset or withdrawal from the bank account, then FMV of such old asset or bank account shall not be considered. They are saying that suppose one old asset is transferred and from that money you acquired the new asset, so new asset value will be considered. So that old asset will not be considered. Old asset will not be considered. Or suppose for an example, from the bank account you have withdraw something and you acquired the asset and this asset is considered, then in bank account it will not be considered. I will take the example and from the help of that example we will understand. All people pay attention. All people pay attention. For an example, try to understand. In the UK, I was purchased one property. So suppose this property I have purchased in UK and cost of this property was 3 lakh. Cost of this property was 3 lakh. And I have purchased on the 13th July 1999. Now suppose I sold this property on 15th April 2003. I sold this asset. And I sold for the 20 lakh. I sold for 20 lakh. But guys, this 20 lakh I have deposited in the bank account. Try to understand. Deposited in the bank account. Deposited in one foreign bank account. Then try to understand this asset value will be, can I say that cost or selling price, whichever is higher? Because if you transfer before valuation date, then cost or selling price, whichever is higher. So can I say that this asset value will be the 20 lakh rupees? This asset value is a 20 lakh rupees. This asset value is a 20 lakh. And guys, this 20 lakh I have deposited in the bank account. This 20 lakh rupees I have deposited in the bank account. This 20 lakh I have deposited in the bank account. So can I say that when I will take the bank account value, so this 20 lakh will already be covered in the bank account, na? When I will consider the bank account as an asset and in bank account I will take the deposit. So this 20 lakh will already be covered in the bank account now. So here guys, this 20 lakh will not be considered while calculating the asset value. So it's very simple. You understood this part or not? Just tell me. Meghna, Shedlena, Shiva, Nehal. Okay, if I sold this asset for 20 lakh, then this asset value is a 20 lakh. But guys, this 20 lakh I have deposited in the bank account. So when we will consider the bank account, when we will value the bank account, so in bank account we will take the deposit. So this 20 lakh will already be covered in the bank account, na? So in bank account value it is already covered. Then in this asset will not be considered while calculating the tax. You understood this point or not? Just tell me. You understood this point or not? You have understood this point or not? Tell me. You understood this point? Yeah. So everyone understood this point. Okay, sir, suppose we sold this asset and we deposited in the bank account. So it will already be covered in the bank account. Na? It will be covered in the bank account. So obviously this 20 lakh will not be considered while calculating the asset value. Done? Now one more example. Guys, for an example, try to understand. Suppose I am having one bank account in Canada or Switzerland, foreign bank account. And suppose in bank account, there was a deposit. So deposit was $10,000, again $10,000, again $20,000, and again $15,000. So can I say that here deposit was 10, 10, 20, it was 40 and 15, it was $55. So $55 was deposit in the bank account. Okay? Now what happened? From this bank account, suppose I have withdraw some amount. I have withdraw from this bank account. I withdraw $15,000 and I have purchased one property. And guys, this property cost was $15,000. I withdraw from the bank account and from that money I purchased that property. Now this property value on the valuation date means 1st April of current previous year, suppose value is a $60,000. So $60,000 is FMV. So can I say that, guys, here, can I say that here I will consider this asset on the valuation date? Answer is yes. 60,000 is value, I will consider. So lawmaker says that okay, when you withdraw from the bank account, then guys, here can I say that this 15,000 I have withdraw from this bank only, na? I have withdrawn the $15,000 from this bank and I have acquired the property, and this property value is a $60,000. So today I will consider the $60,000. So guys, out of value of $55,000, can I say that $15,000 will not be part of $55,000, and here in the bank account value will be only $40,000. So it's very simple. Okay, suppose if you sold any asset and acquired another asset, and another asset is considering in the asset, then that earlier asset will not be considered. Or if anything is withdraw from the bank account, and guys, if that asset is there and it is included in the asset, then guys, in the bank account valuation, that 15,000 will not be considered. Otherwise there will be a double taxation now. Because from same account I am withdrawing and I am purchasing one asset. So this asset will be considered na $15,000. I purchase one asset. So guys, 60,000 and $15,000 higher comes to the 60,000. So when 60,000 is considered here, when $60,000 is considered here, means this asset is considered here, then guys, in the bank account deposit, that $15,000 will be reduced. That $15,000 will be reduced. You got my point or not? You understood my point or not? Yes, sir, we have understood your point. We got your point. Done. Okay. So again, read this line, what this line says. Try to understand. This line says that where a new asset is acquired out of the consideration received on account of transfer of old asset or withdraw from the bank account, then FMV of such old asset or bank account shall not be considered. You got my point or not? Yeah. Now guys, just read this example, and one solution is given. Just read it, and if you have any doubt, then you can ask me. Just read it. Just read it with the solution. Done, people? Done with this example? Everyone done? Hey guys, you have done this example or not? Just tell me, you have completed this example or not? Done with this example? Everyone? Sherilina, Shiva, Nehal. Okay, done. Now guys, sir, suppose for an example, this asset value is in foreign currency, then how to convert it into the Indian currency? So guys, on the valuation date, if asset value is in foreign currency, then how to convert it into the Indian currency? So how we will convert it into the Indian currency? Just we have to take the RBI reference rate. We will take the reference rate on the valuation date, means RBI reference rate. Suppose if it is in dollar, then RBI reference rate from dollar to rupees. Suppose if it is in the UK pound, then UK pound to the rupees. So RBI reference rate we will take. But suppose for an example, that value is in any foreign currency and for which RBI reference rate directly is not given. If RBI reference rate directly is not given, then guys, what we will have to do? First, convert that currency into the dollar and from US dollar to the Indian rupees. So for an example, suppose in the Bermuda, there is an asset located in Bermuda and value is given as per the Bermuda currency. So here value is given as per the Bermuda currency. So from first Bermuda currency to the a dollar, US dollar, and from US dollar to the Indian rupees, that is RBI reference rate is given for the dollar. So here what does this mean? So here rule number 3, sub rule 4 and rule number 3, sub rule 5. What this rule says? Okay, rate of conversion of currency used to determine the FMV of the asset. RBI reference rate on the valuation date. But if RBI reference rate is not given, then FMV of such asset shall be converted into the US dollar from the foreign currency and thereafter US dollar to the Indian currency by the RBI reference rate. Now what is the valuation date? Valuation date for valuation of asset and conversion into the Indian currency. So here valuation date for valuation of asset and conversion into the Indian currency. If asset is declared under section 59, guys, here when this act is came now, that time they have mentioned about you can declare the asset here. So guys, if asset declared under section 59, then 1st July 2015 was a valuation date. But if asset is not declared in any other case, then 1st April of previous year is your valuation date. So your valuation date is a 1st April of previous year. Now, there is some definition is given. We will discuss this definition in the later part. First is the scope of total undisclosed foreign income and undisclosed foreign asset. So guys, which foreign income or undisclosed foreign asset will be covered here under this act? So there is a section 4. Section 4 says that, okay, what do you mean by undisclosed? So undisclosed means very simple. Suppose you file the return of income under section 139.1, 139.4, 139.5. You have not disclosed that asset. Or you was supposed to file the return, but suppose you have not filed the return, because in the income tax, you know that if you remember the section 139.1, in the 139.1 we have discussed that, okay, if you are having any financial interest in foreign entity or you are holding any asset outside India and you are resident or ordinarily resident, then you have to file the return, but you have not filed the return. Then guys, that will be treated as your undisclosed asset or income. So what do you mean by the undisclosed asset or income here? So scope of the total undisclosed foreign income or foreign asset. Total undisclosed foreign income or asset of any previous year would be income from the source located outside India, which has not been disclosed in the ROI, means you have not disclosed in the ROI. File under Income Tax Act 1961 on or before the due date under section 139.1 or belated return under section 139.4 or in the revised return under section 139.5. So you have not disclosed that income. That is called your undisclosed foreign income. Or income from source located outside India in respect of which a return is required to be filed under section 139 of the Income Tax Act 1961, but no return or belated return or revised return has been filed under these sections. Or guys, value of any undisclosed asset located outside India. So value of any undisclosed asset located outside India. Guys, you know that nowadays in the return of income, you have to declare the asset also. You have to give the detail of asset. Suppose asset detail is not given, then it will be covered in the undisclosed asset. Now, some notes are given, and these notes are very simple and logical. Two notes are given, and this two notes says that suppose guys, if any of your income is already covered in the Income Tax Act, then obviously it will not be covered in the Black Money Act, or vice versa. Suppose if any undisclosed income or asset is already covered in the Black Money Act, then it will not be covered in the Income Tax Act. So very simple point. So here, income from source outside India is already included in any assessment or reassessment in income tax. Means suppose if any income from source outside India is already included in your assessment or reassessment under Income Tax Act, under section 29 PGBP, 43C is also related to PGBP, 57 is your other sources and all, 92C is a transfer pricing, then such income shall not be included in total undisclosed foreign income. It's very logical. Okay, like if it is already included, in Income Tax Act, then under Black Money Act it will not be included. Or any income or asset is included in the undisclosed foreign income or asset under the act, under this act, then such income or asset shall not be included in the Income Tax Act. Done. Now guys, there is a one very interesting part here. Okay, how to compute the undisclosed foreign income and asset? Guys, always remember, while calculating the undisclosed foreign income, now any expenditure is not allowed. Any expenditure is not allowed means your gross income is going to be taxable. So here, expenditure or setup of losses not allowed against undisclosed foreign income. So against undisclosed foreign income, any expenditure is not allowed, or any setup of losses is also not allowed. Means gross income is going to be taxable. Any expenditure and all not allowed. In the income tax, normally expenditure is allowed. If there is any income and there is any expenditure against that income, then that expenditure is allowed. But here guys, under Black Money Act, any expenditure is not allowed. Any setup of the losses is not allowed. Now, while considering the asset, here this is the interesting part and last part, I think. So just focus here. If any asset is acquired out of the any income which was already assessed earlier under Income Tax Act, before Black Money Act, or a Black Money Act, then such income shall be reduced. So it's very simple. Suppose guys, for an example, you acquired some asset outside India, and some amount you utilize from the white money and some amount you utilize from the black money. Some amount you utilize from white money, some amount you utilize from black money. Then can I say that whatever money you have utilized from white money means amount income which was already declared in the Income Tax or Black Money Act. So guys, that portion will be reduced while considering the value of the asset. So here, what point number, now what one example is given, pay attention. Mr. Hari acquired share of the foreign company for rupees 10 lakh. He utilized 4 lakh white money and the 6 lakh black money. So 4 lakh white money he utilized and 6 lakh black money he utilized. Now value of such asset as per rule number 3.1 is suppose 42 lakh. Now today value is a 42 lakh. So can I say that in this 42 lakh you have utilized the 4 lakh white money na? So today value should be the 38 lakh. Means the asset, undisclosed asset will be 38 lakh. So what I am saying that one asset is acquired. Here total asset cost was 10 lakh and you utilized 4 lakh white money and 6 lakh black money. So guys, 4 lakh was the white money. So today value is a 42 lakh. So out of 42 lakh, 4 lakh was a white money na. So 4 lakh will be reduced. Here 4 lakh will be reduced. But guys, you are thinking that sir, why you are doing this? Like sir, 4 lakh white money we utilize, 6 lakh black money we utilize, total we utilize the 10 lakh. So can I say that 40% white money we utilize, 60% black money we utilize? So guys, out of the 42 lakh value, only 40% will be reduced now. Means logically 40% should be reduced now. Because 42 lakh multiply by 40%, 42 lakh multiply by 40% comes to the 16 lakh 80,000. So 16 lakh 80,000 should be reduced. Now why only 4 lakh you are reducing? Guys, here we have to reduce only 4 lakh. Means whatever the original amount you have utilized. So whatever the value of today asset and how much white money you have utilized. So you have utilized only 4 lakh white money. So 4 lakh will be reduced. And 38 lakh will be the value of that asset. 38 lakh will be the value of that asset. So that asset value will be 38 lakh rupees. You got my point or not? Yes. But guys, whatever you were thinking that about that proportionate na Nagappan, that is applicable in case of immovable property. In case of immovable property, there will be a proportion. In case of immovable property, there will be a proportion. So here, what happened in immovable property? In continuation of point number B, in case of immovable property, following amount shall be reduced. So in immovable property, we will do the proportion on the today's value. So here, FMV of asset multiply by white money divided by total cost of the asset. So one example I have taken here. A house property located in country outside India was acquired by Mr. A and assessed in the previous year 1213 for the 60 lakh. So you have acquired one property for the 60 lakh in the previous year 1213. Out of the investment of the 60 lakh, 35 lakh was assessed to tax in the total income in the previous year 1213. So 35 lakh was your white money. And in the, like 1213 and earlier year, such undisclosed assets comes to the notice of AO in the current year. And guys, current year value is the 120 lakh. So here we have to do the proportionate when there is a immovable property. So whenever there is a immovable property, so today value is a 120 lakh. Today value is a 120 lakh. And guys, in this 120 lakh, can I say that how much you have invested? 60 lakh, And what was the white money? White money was 35 lakh. So multiply by 35 lakh. So here, if you do the proportion, so 120 divide by 60 multiply by 35, so it comes to the 70. So 70 lakh is your white money value. So remaining 50 lakh is your black money value. So this will be considered in your value of the asset. So what I'm saying that if any asset is acquired out of the black money as well as the white money, so while considering that today's value, whatever white money you have utilized, that will be reduced. Whatever white money you have utilized, that will be reduced. But guys, here, in case of the immovable property, you have to take the proportion. In case of immovable property, this is very logical. You have to take the proportion. So here, immovable property value, today value is a 120 lakh. You utilize the 60 lakh. Out of 35 lakh was white money. So in simple word, can I say that 25 lakh was black money? So here 120 divided by 60 multiply by 25. So directly you will get the 50 lakh amount. So this 50 lakh will be your value of the asset. You got my point or not? Yes. Now guys, some penalty is given. Now what are this penalty? First is section 41. There is a section 41. This 41 says that where tax has been computed in relation to the undisclosed foreign income and asset, then guys, in addition to the tax, a sum equal to the 3 times of the tax so computed, you have to pay the penalty. So here 3 times you have to pay the penalty. So whatever your tax, on that tax multiply by 3 times, you have to pay the penalty. Now section 42 penalty says that failure to furnish return in relation to foreign income and asset, you have not filed the return, which you have to file the return because law says that, Income Tax Act says that you have to file the return. But suppose you have not filed the return, then guys, there will be a 10 lakh penalty. Suppose you file the return, but you failure to furnish the information in return of the income or for the furnishing inaccurate particular about the asset located outside India. Suppose incorrect information you have given, or you have not given the information at all about the foreign asset and all, then guys 10 lakh penalty is applicable. So first is guys, in case of your black money, whatever the tax, on that tax 3 times is a penalty, that is as per section 41. Suppose you have not filed the return, then there is a penalty of 10 lakh rupees. Here, like you file the return, but you have not disclosed the foreign asset or foreign income, then guys 10 lakh rupees penalty. Now default in the payment of the tax arrear. So whatever tax you have to pay to the government, suppose you are not paying the tax, then guys 100% of the tax arrear will be the penalty. Now failure without reasonable cause to answer any question put to him by the tax authority or to sign any statement made by him in the course of any proceeding under the act, or to attend or produce books of accounts or document at a place or time in response to summon issued under section 8. So guys, suppose you have not answered to the department send you some notice, you have not answered them in that particular case, or suppose you have not made the statement, or you have not attended the, like they ask for the books of accounts, you are not producing the books of accounts, then there will be a penalty of 50,000 to the 2 lakh rupees. So here will be the penalty of the 50,000 to 2 lakh rupees. Now guys, in the Black Money Act there are sections 6 to 88 also, and these sections are all procedural part in the Black Money Act. It is a similar to the DT part. Okay, suppose you are not satisfied with the AO order, then you will make the appeal to the CIT appeal, after that ITET appeal, after that High Court appeal, after that Supreme Court appeal. If there is a rectification, you will go for the rectification. There is a revision like a 263, 264, same is in Black Money Act, but that is not relevant for you. And ICA also not covered, so all the section they covered small some part, they have not covered all the part. Okay, so this is the completion of this part. Now directly check some question from your compiler, and guys, just do the question number 2 and question number 3. Just do the question number 2 and question number 3, and after that just read the question number 5. First do the question number 2, question number 3, and read the question number 5. Done, people. Question number 5. Question number 2 and 3 you have completed or not? Just tell me 2 and 3. Any doubt in question number 2 and 3? I think 2 and 3 were similar, na, whatever we did in the compact example. 2 and 3 were similar. Any doubt in question number 2 and 3? No? 2 and 3 done, na? 5 is still pending. Yeah. So 5 we will do. Don't worry. Question number 5. All people pay attention. So there is one person, name is Mr. Deepak. Age 45 years. Indian citizen. Deepak, age 45 year. Indian citizen. Has settled in the California. So he settled in the California in USA since 2015. Prior to that, he was always been in India. So before 2015, he was in India, but now he settled in California. He is a non-resident now. He had acquired a residential property in California in 2009. So guys, can I say that in 2009 he was a resident? That time he acquired the residential property for the USD $20,000. He kept bank deposit of USD $10,000 in the bank account in the New York since 15th April 2010. So he has opened one account in the New York and he deposited 10,000 in that account. Now notice under black money, undisclosed foreign income and asset and imposition of tax act 2015 was issued on 20th October 2023. So in current year they issued the notice. Current year they came to know about this asset. So guys, can I say that current year your valuation date will be the 1st April 2023? That is your valuation date. 1st April 2023 is your valuation date. Now, the fair market value of residential property is given on the 1st April 2023, means on the valuation date FMV of that asset is given as $25,000. On the 1st April 2024, means next year value on 1st April 2024, it is given $32,000. And guys, on the date on which notice is issued, it is given value is a $30,000. Now, the bank deposit with the accrued interest thereon was $12,500 on 1st April 2023. Bank account value was 12,500. Now 12,800 in the next year 1st April, and on the date on which notice is issued, bank account value was 12,700 USD. Now USD means United States dollar. The exchange rate of Indian currency of the USD as per reference rate of RBI is given on the 1st April 2023. It is a 71. 20th October 2023 72, and guys 1st April 2024 73. Compute the value of undisclosed foreign asset chargeable to tax in hands of Deepak as per the Black Money Act 2015. So guys, there are two assets. One is the residential property and one is the bank account. Can I say that residential property you acquired for $20,000 and bank account you deposited $10,000 in the year in which you were a resident, means earlier you were a resident, na? So in that year, that bank account you have opened as well as the property you have acquired. So it will be covered in the Black Money Act. Now guys, what will be the value? So can I say that residential property or value will be the whatever the cost or FMV as on valuation date, means NRV as on valuation date, whichever is higher. So your cost was $20,000 for the house property, and guys, and value as on valuation date 1/4/2023 is at $25,000. So can I say that I will consider $25,000 here? I will consider the $25,000, that is $25,000 means USD $25,000, because 20,000 was your cost and 25,000 higher comes to $25,000. So here we will say that $25,000 will be the value, and this value will be converted into the Indian currency, whatever the reference rate as on the valuation date. So valuation date, that reference rate is a 71. So we will multiply by that $25,000 multiply by 71. That will be the value of residential property. But now question is the bank account. Nidhi, there is a one interesting part, sir, bank account. In case of the bank account, how to value the bank account? Bank account is very simple. Just take the deposit amount. So guys, whatever deposit, just consider that. Now, in case of bank account, there is no need to check that what is the value on 1st April 2023 or 1st April 2024 or like on the date on which notice is issued. No, guys, just we have to take the deposit amount. So here deposit in the bank account was only $10,000. So deposit in the bank account was $10,000. So bank account value will be considered as $10,000 only. $10,000. Now you may ask, sir, now this value of the bank account is 12,500 now due to the interest and all. But guys, that interest is not taxable now. Interest is not taxable because now he is a non-resident. Now he is a non-resident, so interest and all is not taxable. Just bank account, that asset will be considered, and in asset just we will take the deposit amount. So whatever deposit amount that we will consider, and here deposit amount is a 10,000. So 10,000 we will consider, multiply by 71 is a USD per dollar rupees rate is a 71 on the date of the valuation, that is 1st April 2023. So just check your answer. Okay, just check your answer. Question number 5. So this all 5 questions we have covered from ICI material. Okay, ICI has given 5 questions, and I think in the examination you will get the 4 mark question out of this 5 question or similar question to this 5 question. Just check it. Done, people? If you're done, then just say done. Okay, sir, conversion rate of bank account will be taken on 1st April. Yeah, that is the valuation date. Always conversion rate will be the 1st April of previous year. That is valuation date. Okay, Nagappan is asking one doubt. Sir, in question number 5, should we assume that the asset created in foreign land is not out of the income charged under Income Tax Act 1960 unless explicitly stated so? When they ask about the question of black money, and they are sending the notice, it means it is assumed that that income was not disclosed in the India, and you have the any asset outside India that is out of the undisclosed income. Done. Now guys, in this topic there is a one small part is there, but that is not more relevant for the examination point of, not relevant at all for the examination point of view. Some meaning is given of the some terms. One is the quoted share and security, because I have mentioned that quoted share and security. But sir, what do you mean by the quoted share and security here? Quoted share and security means share and security listed in the recognized stock exchange outside India, means in NASDAQ and all. That is called quoted share and security. So what do you mean by quoted share and security here? All people pay attention. So they are saying that a share or security which has the meaningful volume of trading on an ongoing basis on the established security market and regularly quoted by dealer where they actively do offer to and in fact do purchase the share from or sell the shares to customer who are not related to the dealer in the ordinary course of business. So this definition is given for the quoted share and security. So they are saying that quoted share and security means to share or security which has the meaningful volume of trading on an ongoing basis on the established security market and is regularly quoted by the dealer where they are actively do offer to, and in fact do purchase the shares from and sell the shares to customer who are not related to dealer in the ordinary course of business. That is called your quoted share and security. But here they use the word established security market. Now what do you mean by the established security market? So here established security market definition is given. Established security market means an exchange that officially recognized or supervised by the government entity in which the market is located, and that has a meaningful annual value of the shares traded on the exchange. Now guys, it means a Nasdaq. So Nasdaq is located in USA, and USA government company is supervised that market. Government is supervising, officially recognize that market. That is called your established security market, but where meaningful annual value of the shares traded in the exchange. But question is now, okay, what do you mean by the meaningful annual value of the shares traded on the exchange? So it means, with respect to the exchange, it means it has an annual value of shares traded on the exchange or a predecessor exchange exceeding 1 billion United States dollar during each of the 3 calendar year immediately preceding the calendar year in which determination is being made. So except current year, in the last 3 year, in all the 3 year, if 1 billion United States dollar means 1 billion USD, 1 billion USD share, like value of the traded value, share value of the traded, then that stock exchange will be known as the meaningful annual value of the share traded in the exchange. So guys, this is the definition part. There is no need to remember this. Okay. Now here they mention that quoted share and security means the security which has the meaningful volume of trading on an ongoing basis. Now what do you mean by the meaningful volume of the trading on ongoing basis means? So they define here meaningful volume of the trading on ongoing basis means with respect to each class of the share. It means trade in each such class are affected other than de minimis quantity in one or more established security market on at least 60 business days during the prior calendar year. Means in case of that particular security, in the last calendar year, at least 60 business days there was a trading, except the de minimis quantity. De minimis quantity means except the small 1 or 2 quantity, just ignore that. But otherwise there was a 60 business days on which that share were traded. That is called your meaningful volume of trading on ongoing basis. An aggregate number of share in each such class that are traded on such stock exchange or market during the prior year, at least 10% of the average number of share outstanding in that class during the prior calendar year. So whatever the total number of share, average number of share, out of that at least there was 10% trading was there, at least 10% share were traded. So this is the definition part. Obviously not expecting the question from this, what do you mean by that? Okay, so this you can ignore. Okay, so this is the completion of your topic, Black Money Act. 5 questions are there. Free 4 marks you will get in the examination, and short you will get the question in the examination. This is the free marks. Just they will ask you simple question. In the MCQ they will ask you, or they will ask you in the descriptive 4 mark question from this topic, 100% sure. And out of that 5 question, any 1 question or similar question you are going to get in your examination. Okay. Now guys, we are going to start with one topic. The topic name is set up and carry forward of losses. Set up and carry forward of losses. But before starting this topic, just tell me one thing. Nidhi is from Mumbai only. Suppose Nidhi, Miss Nidhi caste is Brahmin. Suppose Nidhi caste is Brahmin. Brahmin is a caste of Nidhi. Now suppose Nidhi married to a guy, that is suppose Mr. X, and that Mr. X caste is Jain, and both married. They are going to marry. My question to all of you, both are from different caste. Nidhi Brahmin and Mr. X is Jain. This marriage will be known as intercaste marriage, or this marriage will be known as intra-caste marriage. Just tell me. This marriage will be known as intercaste marriage or intra-caste marriage. Intercaste marriage or intra-caste marriage. Tell me. intra or inter, different caste. Nidhi, Brahmin, and Mr. X is Jain. So Brahmin and Jain, this marriage is a intercaste or intracaste? So there is a marriage in different caste. Marriage in different caste, Brahmin and Jain. This marriage is an intercaste marriage or intracaste marriage. Right answer is many times we say that girl did the intercaste marriage. So intercaste means within the caste or outside the caste. Right answer is this marriage is known as the intercaste marriage. Intercaste marriage means outside the caste. And intra-caste means within the caste. If Nidhi married in the Brahmin family only, then it will be known as the intra-caste marriage within the caste. And if Nidhi is married in any other caste, that will be known as the inter-caste marriage. You heard about in the GST about interstate sale and intrastate sale. So intrastate sale means within the state. But interstate sale means outside the state, means from one state to another state. That is called your interstate sale. But within the state, then it will be known as the intrastate sale. So on the same line, guys, in the setup and carry forward of the losses, we will discuss about the two type of the adjustment. One is your intra-head adjustment and one is your inter-head adjustment. Intra-head adjustment means within the head. But inter-head adjustment means from outside the head. Means one head loss will be set up against profit from another head. That is called your inter-head adjustment. But intra-head adjustment means within the head, if you are set up the losses from source of another income, but within the same head, that is known as the intra-head adjustment. Guys, just tell me, if house property losses are set up against salary income, this adjustment is inter-head adjustment or intra-head adjustment? Tell me. House property losses are set up against your salary income. This adjustment is your intra-head adjustment or inter-head adjustment? Salary income, house property losses. Salary income, inter-head adjustment. Everyone says that inter-head because we are set up against another head, na? Salary income, house property loss, inter-head adjustment. Tell me, short-term capital loss, long-term capital gain. Short-term capital loss and long-term capital gain. Short-term capital loss, long-term capital gain. Short-term capital loss, long-term capital gain. Short-term capital loss, long-term capital gain. That is the intra-head adjustment. Because within the capital gain head, you did the adjustment. Suppose my house property, Mumbai house property loss and Rajasthan house property gain, that is set up. That is called your intra-head adjustment. But suppose business loss and capital gain head income, business loss and capital gain head income, business loss and capital gain head income, then it is an inter-head adjustment. So guys, you know that there are basically 5 head of income. One is the salary, one is the house property, one is the PGBP, one is the capital gain, and one is the income from other sources. Income from other sources. Now always remember, whenever we need the help, first we ask to our family member. Means first we ask to our family member, but suppose our family member is not helping, then we will ask to the neighbor. So guys, always there is a loss under any head, na? Then first you have to set up against income from that head only. But guys, if within the head there is no help, then you will ask help from the another house. Then you will ask help from the another house. You got my point or not? Yes. So first we are going to discuss, all people pay attention. Huh? Don't look into your book, just focus here. First section we are going to discuss, that is the section number 70. And section number 70 is about the intra-head adjustment. Intra-head adjustment means, like within the head you can do the adjustment, within the head, but within the head only, no other head, within the head you can do the adjustment. This is called your intra-head adjustment. Means suppose if there is a loss from one source, that can be set off against income from another source, but within the same head of income, like short-term capital loss can be set off against long-term capital gain. Suppose my Rajasthan house property loss can be set off against Mumbai house property gain. Suppose my textile business loss can be set off against my coaching class business income. Suppose my one business loss can be set off against another business income. So that is called your intra-head adjustment. Means within the head you are doing the set off. Within the head only you are doing the set off. That is called your intra-head adjustment. So you can do the intra-head adjustment. There is no issue at all. Intra-head adjustment is allowed. And first you will do the intra-head adjustment only. Guys, intra-head adjustment, but there are basically 4 exceptional cases. All people pay attention. I need your 100% attention, because this topic, if you understood now, then this topic you will able to understand within the like 20 minutes. Otherwise you will never be understand this topic. So try to understand. First is the intra-head adjustment. Intra-head adjustment means within the head. But guys, there are basically 4 exceptional cases. There are 4 exceptional cases. 1, 2, 3 and 4. First point says that if there is a speculative business loss, then it can be set off only against speculative business income. If there is a speculative business loss, that can be set off only against speculative business income. Second exception is, if there is a specified business loss means that 14 business. You know that 14 business means cold chain facility, warehousing for agriculture produce, petroleum, natural gas pipeline, hotel 2-star or above category, hospital 100 bed or more, housing project under slum redevelopment, housing project under affordable housing scheme, production of fertilizer in India, beekeeping, bee honey, bee wax business, container depot, container freight station, warehousing for sugar, slurry pipeline for transportation of iron ore, semiconductor wafer fabrication manufacturing unit, and new infrastructure facility. That were the 14 business. So guys, if there is a specified business loss now, then can be set off only against specified business income. Means it cannot be set off against any other business income. Now third point says that suppose if there is a long-term capital loss, means if there is a long-term capital loss now, then it can be set off only against long-term capital gain. Next is, suppose if there is a owning and maintaining race horses, means if you are owning and maintaining race horses means we are talking about the horses, we are not talking about the races, because there is a difference between the word race horses and horse races. If I say horse races, it means I am talking about the races, but here I am talking about the race horses. Race horses means I am talking about the horses, not races, horses. So if any person is owning and maintaining race horses, then guys, if there is a loss from owning and maintaining race horses, that can be set off only against same type of income. Same type of income means same income is owning and maintaining race horses. So guys, normally first point says that, all people pay attention, like intra-head adjustment you can do it. Intra-head adjustment is allowed. Intra-head adjustment means within the head you can set off. Within the under the PGBP head, you can set up one business loss with another business gain. No issue at all. You can do that. House property, within house property, one house property loss, another house property gain, you can set up it. Capital gain, you can do it, no issue at all. Other sources, you can do it, no issue at all. But guys, there are 4 exceptional cases. First exceptional case is if there is a specified business loss, means that 14 business loss, then it can be set up only against a specified business income. Means I can take an example. Suppose if there was a hotel business loss, hotel 2-star or above specified business, hotel business loss can be set up against coaching class business profit or not? Answer is no, it's not allowed. Means hotel business loss cannot be set up against coaching class profit. That is not allowed, because a specified business loss can be set up only against a specified business income. Because this point says that a specified business loss can be set up only against a specified business income. But guys, can you tell me, suppose if there is a specified business income and non-specified business losses, that can be set up or not? Because hotel business loss and coaching class profit, that cannot be set up. But suppose hotel profit and coaching class loss, that can be set up or not? Tell me. I am waiting for your answer. Just tell me. If there is a specified business loss, that can be set up only against a specified business income. But guys, if there is a normal business loss, is that can be set up against a specified business income or not? Means your coaching class business loss can be set up against hotel business profit or not? Right answer is yes, that can be set up. No issue at all. No issue, because law says that if there is a specified business losses, that can be set up only against a specified business income. But there is no specified business loss. There was a loss from coaching class business and profit from hotel business. That can be set up. Answer is yes, that can be set up. No issue at all. That can be set up. No issue at all. So what I am saying that if there is a specified business loss, 14 business loss, that can be set up only against 14 business income. It cannot be set up against any other business income. But hotel loss can be set up against hospital. Answer is yes. Both are specified business. It can be set up. Or hotel business loss can be set up against the slurry pipeline. Both are specified business. It can set up. But guys, hotel business loss cannot be set up against the coaching class business profit. But if there is a coaching class business loss, that can be set up against the hotel profit. You got my point or not? Yes. Now, second is a speculative business. Suppose if there is a speculative business loss, that can be set up only against a speculative business gain. Long-term capital loss can be set up only against long-term capital gain, guys. Hey guys, can you tell me, in the capital gain head, can I say that there can be only 2 probability? Means in the capital gain head, there can be 2 probability. Either one is the long term and one is the short term. There can be 2 probability only, long term and short term. Now this point says that if there is a long term capital loss, that can be set up only against long term capital gain. Means if there is a long term capital loss, that can be set up only against long term capital gain. It means guys, if there is a short term capital loss, that can be set up against long term capital gain or not? Answer is yes. Because restriction is only for the long term capital loss. Okay, if there is a long term capital loss, that can be set up only against long term capital gain. So if there is a short term capital loss, that can be set up against long term capital gain or not? Answer is yes, it can be set up against long term capital gain. So guys, can I tell you, guys, always remember this capital gain head, this capital gain head is a Ambani family. Remember Ambani family. And 2 brothers are there. That big brother, big bull, name is a Mukesh Ambani. Mukesh Ambani is long term. And Anil Ambani is basically short term. Always remember, Mukesh Ambani can help to the Anil Ambani, because Anil Ambani don't have anything in the life now. Mukesh Ambani can help to the Anil Ambani, but Anil Ambani cannot help to the Mukesh Ambani. So what I am saying that, suppose if long-term capital loss If the Mukesh Ambani is needing help, he is need the help, then short-term capital gain cannot help him. Means long-term capital loss cannot be set off against short-term capital gain. But suppose if there is a short-term capital loss, Anil Ambani required the help. Anil Ambani required the help. Then Mukesh Ambani can help him or not? Answer is yes. If there is a short-term capital loss, then it can be set off against long-term capital gain. If there's a short-term capital loss, that can be set off against long-term capital gain. But guys, long-term capital loss cannot be set off against short-term capital gain. So always remember that Mukesh Ambani can help to the Anil Ambani, but Anil Ambani cannot help to the Mukesh Ambani. So long-term capital loss, that cannot be set off against short-term capital gain, but there is a short-term capital loss, it can be set off against short-term capital gain or long-term capital gain. You got my point or not? Yes, sir, we have understood your point. Now try to understand one more point here. This is just to remember you, but why it is, logic behind that is, guys, you know that long term is normally taxable at concessional tax rate. So suppose long term is taxable at 20% and short term is taxable at 30%. Normally, long term is taxable at 20%, short term is taxable at 30%. So is government will allow you to set up your income of 30% against the losses of 20%? Answer is no. Otherwise government will be in the loss of the 10%. Na? Suppose if government allow you to set up the long-term capital loss against the short-term capital gain, then people are so happy because long-term practically taxable at 20%. And short term is taxable at 30%. So guys, 20% income losses are allowed to set off against 30%. Then people will be happy. Government will be in the loss na. So that's why government says that if there is a long term capital losses na, then we will allow to set off only against long term capital gain. We will allow to set off only against long term capital gain. Now last is a owning and maintaining resources loss can be set off only against owning and maintaining resources. If there is a owning and maintaining resources losses from this activity, it will be set up only against owning and maintaining resources only. You got my point or not? Yes. Now try to understand one more point. This is first you will do the intra-head adjustment, means within the head only. Within the head only. Now guys, if within the head there is no sufficient profit, then you will ask from another head. So you will do the inter-head adjustment. Now I need your attention. Huh? So here there is a one section, that is the section 71, that is your inter-head adjustment. Inter-head adjustment means you can set up against any other head, no problem at all. There is a house property loss can be set up against salary. Business loss can be set up against capital gain. So other head income can be set up the loss of the another head. So this is called your inter-head adjustment. But guys, in inter-head adjustment, there are total 6 exceptional cases. There are total 6 exceptional cases. And guys, these 4 cases are as it is. Try to understand. Huh? These 4 cases are as it is. As it is means these 4 cases are same as it is. Like this speculative business loss can be set up against a speculative business income only. Specified business loss can be set off against a specified business income only. Long-term capital loss, only long-term capital gain. Owning and maintaining resources, only owning and maintaining resources. Now there may be one doubt in your mind, okay, sir, why you have written again here? When you have written already here in the intra-head adjustment, then why you are again writing here in inter-head adjustment? There is a reason behind that. Try to understand. When I have mentioned here now, intra-head adjustment, it means, guys, if there is a speculative business loss, it can be set up only against a speculative business income. It means you cannot set up against any other business income. Means speculative business loss can be set up against only speculative business income. It means you cannot set up against any other business income. Means here speculative business loss is there, then from coaching class business income you cannot set up. And when here I am writing in the inter-head adjustment, it means, guys, speculative business loss cannot be set up against salary, cannot be set up against house property, cannot be set up against capital gain, cannot be set up against other sources. So you understand logic why I am writing again here? Because this speculative business loss cannot be set up against salary income, It cannot be set off against house property income. It cannot be set off against your business income. Like capital gain income. It cannot be set off against your like other sources income. It means speculative business loss can be set off only against speculative business income. Or specified business loss, only specified business gain. Long-term capital loss, only long-term capital gain. Owning and maintaining resources, only owning and maintaining resources. So 4 exceptional as it is. Now, I am writing 5th adjustment. 5th exception. 5th point says that suppose if there is a short-term capital loss. Short-term capital loss. So short-term capital loss can be set off only against either short-term capital gain or long-term capital gain. So here, if there is a short-term capital loss then it can be set off only against short-term capital gain or long-term capital gain. Guys, try to understand. In the capital gain head, there can be only 2 possibilities. One is the short-term and one is the long-term. So there can be only 2 possibilities. One is the short-term, one is the long term. Now, if there is a long term capital loss, that can be set off only against long term capital gain. If there is a short term capital loss, it can be set off against only short term capital gain or long term capital gain. It means, guys, can I say that this short term or long term capital loss cannot be set off against any other head income? No, not possible. It means you can understand that this capital gain head is basically a Ambani family. Ambani family in India. Big brother can help to the younger brother, but younger brother cannot help to the big brother. And one more point, guys, you and me, we are poor people. We cannot help to this family. Suppose we are PGBP. So against PGBP income, is capital gain losses are allowed to set off? Answer is no. Is we are able to help to the Ambani family? Even Anil Ambani? Answer is no. He is rich than us. Don't worry about that. He is richer than us. He is that he is having huge money. So we are not able to help them, but they can help to the other families. Guys, still capital gain head is a Ambani family. They can help to the others, but you cannot help to the Ambani family. Means here you cannot help to the capital gain. Here you cannot from salary income, you cannot set off the capital gain losses. House property you cannot set off. PGBP you cannot set off. IFRS you cannot set off. But guys, suppose if there is a loss in the PGBP, loss in the house property, is capital gain head can help or not? Answer is yes, it can help. It can help. It can help. So always remember, Ambani family can help to the other people. Means suppose if PGBP is poor people, then capital gain can help if they are having the profit. But suppose if there is a loss in Ambani family, you cannot help them. So in simple word, Ambani family can help to the other people, but you cannot help to the Ambani family. So in simple word, I am saying that. In the simple word, I am saying that. Try to understand. Okay, guys. If there is a long-term capital loss, then only long-term capital gain. If there is a short-term capital loss, then it can be set off only against short-term capital gain or long-term capital gain. Now, guys, last exception. They are saying that PGBP losses cannot be set off against salary. So this is one exception. This exception says that PGBP losses cannot be set off against salary. So PGBP losses, suppose if there is a PGBP losses, then you can set off against house property. Answer is yes. You can set off against capital gain. Answer is yes. You can set off against other sources. Answer is yes. But guys, against salary, it is not possible. PGBP losses are not allowed to set off against salary, but against other head it is allowed. Answer is yes. So if there is a PGBP losses, it can be set off from house property. Answer is yes. It can be set off from capital gain. Answer is yes. It can be set off from other sources. Answer is yes. But it cannot be set off from the salary. From salary it is not allowed. So PGBP losses are not allowed to be set off. PGBP losses are not allowed to be set off against the salary. So there is a one restriction. So this all are the 6 exceptional cases. Now guys, I am going to show you mind map. But for mind map, I need your 100% attention. Don't look here and there. Don't look into your book. Just focus here only. Just focus here only. Within 2 minutes this topic will get over. This concept will get over. I need your 100% attention because we are going to discuss about the mind map. Now what is the mind map? All people just focus here. We'll discuss the mind map. All people pay attention. I need your attention. Done. I need your attention. Mind map. And guys, if you understood this mind map now, then I assume that whatever we have discussed about the interhead and intrahead, you have understood. Okay. Guys, suppose first we will discuss okay, in examination, suppose you are solving the question and if you get any loss, then what you will do? Under salary head, is loss is possible? Answer is no. Under salary head, loss is not possible. So under salary head, guys, loss is not possible. No, loss is not possible under the head salary because salary can be nil, but salary cannot be a negative salary. Salary can be nil, but never be negative. So here under salary, loss is not possible. Loss is not possible. But question is that under house property, is losses is possible or not? Answer is yes, loss is possible. Guys, under house property, loss is possible. Suppose if there is a loss, focus here only. If there is a loss under house property, what you will do? First, you will do the intra-head adjustment. Means your first step will be the intra-head adjustment. After that house property losses, you will do the inter-head adjustment. And guys, after inter-head adjustment also, if there is no set off, then can I say that you will do the carry forward? You will do the carry forward. It means first you will do the intra-head adjustment, then you will do the inter-head adjustment, and after that also if there is no set off, you will carry forward. And guys, here you will carry forward and you will carry forward for the next 8 assessment here. So try to understand. If there is a house property loss, first step will be the intra-head adjustment. After that, you will do the inter-head adjustment, but always remember, house property head losses can be set off against any other head is only maximum 2 lakh. Up to maximum 2 lakh losses can be set off against any other head. And guys, after that, you will carry forward for the 8 assessment here. So there will be a step. Now suppose if there is a speculative business loss, then guys, can I say that if there is a speculative business loss, first you will set off against speculative business gain only. And suppose if there is no speculative business gain, then can I say that directly you will carry forward? And you will carry forward for the 4 assessment here. Guys, here speculative business loss can be carried forward for the 4 assessment here. One more point. Suppose if there is a specified business loss, then can I say that specified business loss, first you will set off against specified business income. But if there is no specified business income, then directly you will carry forward, and specified business loss can be carried forward for the unlimited period, guys. Now next part, if there is any other business loss, can I say that if there is any other business loss, first I will do the intra-head adjustment. From business only I will set off. After that I will do the inter-head adjustment, but other than salary. Means if there is a business loss, first I will do the intra-head adjustment. Second, I will do the inter-head adjustment, but guys, other than salary. And after that, business losses will be carried forward for the next 8 assessment year. After that, business losses will be carried forward for the next 8 assessment year. Suppose if there is a capital loss, short-term capital loss, can I say that first you will set off against short-term capital gain or long-term capital gain? And after that, directly you will do the carry forward for next 8 assessment year. If there is a long-term capital loss, you will set off against long-term capital gain, and after that you will carry forward for the 8 assessment year. Guys, under income from other sources, if there is a owning and maintaining resources loss, then guys, first you will set off against same income, that is owning and maintaining resources. After that you will carry forward for the next 4 assessment year. One more point, if there is any other sources losses, then first you will do the intra-head adjustment. After that you will do the inter-head adjustment, and after that, guys, carry forward is not allowed. means other sources losses carry forward is not allowed. Other sources losses carry forward is not allowed. You understood or not? Yes. So this is called your mind map. If you understood this mind map, it means you understood this intra-head adjustment and inter-head adjustment. And if you have not understood this mind map, it means you have not understood anything till now. Now guys, try to understand one last point. Pay attention. Meghna, pay attention. Nidhi, Nehal, try to understand. Suppose there was a loss under the head house property. Yeah? There was loss under the head house property. This loss of the current year. So current year there is a loss. First you will do the intra-head adjustment. After that you will do the inter-head adjustment. After that you will carry forward. Guys, if this losses is carry forward in the next year, then now it is allowed to be set off only against that head. It means inter-head adjustment is not possible. Inter-head adjustment is not possible. So what I am saying that if there is a losses, this losses first you will do the intra-head adjustment, means within the head. After that you will do the inter-head adjustment. After that you will do the inter-head adjustment. After that you will carry forward. And if losses are carry forward, then guys you will not able to do now inter-head adjustment. Only intra-head is possible. It means suppose house property loss. First you will set off against house property income. After that you will set off against any other head income. And if it is carry forward, then guys in the next year, next 8 years, you will not able to set off against any other head except the house property. So Meghna, you can understand that. Meghna, suppose for an example, your marriage age is like suppose 22 years, 25 years for an example. And now you have an option, either in your same caste or like any other caste also. Other caste, intercaste is possible. But once your age is carry forward, suppose you are 35, then only your caste is option. That intercaste option is not there. Intercaste option is not there. So what I am saying that if there is any loss, if that losses is carry forward, so once it is carried forward, then inter-head adjustment benefit is not available. Only intra-head benefit is available. It means only in your caste you can marry, like other caste is not possible. So guys, if you will see this table, then losses from house property, once it is carry forward, then it can be set off only against house property income. Business losses can be set off only against business income. Short-term capital loss only against short-term capital gain or long-term capital gain. So guys, now we are stopping here. But whatever given before section 79 here, whatever given before section 79, you have to read it. Whatever given before section 79 here, that is, you have to study it, you have to read it, and after that you have to do some question also today. Which question you will do? So guys, please mark some question, some homework question, please mark. You will do the question number. Today you have homework and you have to do it. Question number 4 to question number 9. 4, 5, 6, 7, 8, 9. 10 also you can do. Question number 4 to 10. 4 to 10. Guys, this is a small question. I think it will not take more than 30 minutes to do all the question 4 to 10. So just do the question number 4 to 10. And remember, whenever you solve the question like in the setup and carry forward, then sir, how to proceed with the question? It's very simple. First, just write the income. Means suppose if there is an income from salary, then first write the income from salary 2 lakh rupees. After that, suppose if there is a PGBP income, just write the PGBP income of the 5 lakh. Suppose if there is a IFOS income, then just take the IFOS income of 7 lakh. So income is profit, just write that. After that, just consider the losses. If there is a losses, then suppose house property losses current year, it can be set off against salary? Answer is yes. So we will set off the house property losses of the 2 lakh. So here salary income is nil. So what you have to do, first take the income, and after that just give some space like salary income. After that just leave 2 line blank. After that just write any other income. After that just 2 line blank. After that write again other income. And just if there is any loss and if it is allowed to set up, just set up it. And always remember, if current year there is a income and in current year there is a losses, then loss first will be set off of the current year losses. And then also there is a income, then brought forward losses you can set off. And guys, unabsorbed depreciation. And unabsorbed depreciation is very beautiful thing. Unabsorbed depreciation can be set off against any head of the income other than salary. So even in the carry forward year, unabsorbed depreciation can be set off against any head of the income. So what you will do, whatever written before section 79, first you will read it. After that, you will do the question number 4 to 10 from your compiler. Thanks a lot, people. That's enough for today from my side. See you tomorrow. Bye. Take care.